November CPI coming in just as expected. The core reading up 3.3% on a year-over-year basis. Joining us right now is former Fed Governor Frederic Mishkin. He's now a professor at Columbia University. Rick, it's great to see you. So I'll ask you, first of all, just the basic question. You look at this number, you put yourself in Jay Powell's brain / the rest of the Fed, and you think to yourself what?
So I think there's going to be really interesting discussion at the upcoming FOMC meeting. These numbers are coming in as people expected, but they're not great numbers. And you see a stalling in this path down to 2%. It is true that from a point of view of the real interest rate, which is the interest rates adjusted for inflation, which is what really does affect the economy, there's some restrictive policy here. However, we're in a situation where there's other elements of the financial markets that are very buoyant, particularly the stock market. So there's really a situation here where the Fed may not really be restrictive enough given the numbers. So they sort of don't want to surprise people, so that it's likely they're going to cut at this meeting. But on the other hand, I think there's going to be a lot of discussion going on about whether, in fact, the numbers are not coming in as good as they'd like them to. They don't want to get stalled at 3% and not be on a path to the 2% target. And so the likelihood of them actually having to pause in terms of cutting rate is now getting a lot higher.
So, I don't know if you were listening to the last conversation we're having, but one of I think the big questions is whether the Federal Reserve should, on a prospective basis, be making any kind of decisions ahead of what may actually happen with Trump, the Trump administration, and this Congress, which is to say, if you start to believe the tariffs are coming, if you start to believe the DOGE is coming, if you believe in any of those, if you believe any of those things are going to happen the way they've been described, are you supposed to get ahead of them, or are you supposed to wait to see whether they happen, how they happen, and then get the reaction to them? But by the time you get the reaction to them, are you already behind?
So I think the one thing that is sure about this next administration is the unpredictability. I mean, this is one of Trump's hallmark aspects, which is, he says he's going to do one thing, the other things happen. He flips on a dime. This is not Trump is not somebody who operates on deep principles. He's very transactive, and so we just don't know. And there's also an issue that many of these things that Trump has talked about could be a one-shot deal where it comes in but will affect the price level, but not necessarily inflation over a longer horizon. So I think the Fed basically is got to wait, and there's no reason not to wait right now on this. And certainly they don't want to act or say that they're reacting to potential policies. That's not the way the Fed really wants to operate, because it gets them into the whole political debate about whether they're helping the administration, they're hurting them, or whatever.
But so you ultimately believe they need to stick with this 2% idea?
Oh, absolutely. There's always an issue about how fast and how aggressive you have to be in getting down to 2%.
Right.
So, for example, if the economy's not doing that well and you're still inflation, which is a little bit high, you should actually not work very hard to get it down to 2% quickly. In fact, when we describe inflation targeting, in terms of the research on it, which I've been a very big participant in, we actually describe it saying it's flexible inflation targeting. That you should worry about where the economy is. You do have to worry about these other factors, and the way you build that in is not by changing the target, but actually talking how quickly you want to get back down to the target. Right. And so in this context, there's a lot of flexibility built in. What I think that is important is that when inflation is higher than you'd like, you don't want to be in a situation where, say, you're going to just accommodate that.
Right.
That actually produces very bad expectation dynamics. Actually, there's a lot of research and theory and actually applied work that indicates that actually hurts your outcomes. It's very important to get this nominal anchor in place in a strong way, but then quickly I'm a sailor, so how far out you put the lines to your anchor is something that you have to do by judgment, and that's exactly what they need to do.